Hello everyone. Today we starting the lecture number 17, that is for transnational exposure. After the economic exposure and the transaction exposure, we are about to start the lecture that is about the translation exposure. Management of translation exposure. What are the chapter objective we have? The chapter discuss the impact that unanticipated change in the exchange rate may have on the consolidated financial statement of the multinational company. So what are the chapter objective of this particular topic? This chapter discusses the impact that unanticipated changes in the exchange rate may have on the consolidated financial statements of the multinational company. Transnational method, FSAB Statement 8, FSAB Statement 52, Management of Translation Exposure, Empirical Analysis of Change from FSAB 8 to FSAB 52. So what is all about the translation exposure risk? The risk related to the holding assets or liabilities in a foreign currencies. The risk is related to the holding assets or liabilities in a foreign currencies. Whenever there is a certain unanticipated changes or certain fluctuations in the exchange rate, which is directly affecting the company's cash flows and also affecting the consolidated financial statement. So whatever the risk is related to the holding assets, if you are holding the assets or liabilities in a foreign currency, so there will be a risk that is called translational risk. This risk can be difficult to measure. This risk can be very difficult to measure as the level of asset or liabilities can differ from day to day and can be difficult to quantify quickly. Yes, it's true. It's very hard to understand, hard to measure this type of risk because as the level of asset and liabilities can differ from day to day. Because depending on the currency, if the currency is appreciating or depreciating day by day, automatically what will happen? It will be your asset and liabilities will be differ from day to day and can be difficult to quantify quickly. So it's very difficult to quantify the quickly. That is called asset and liabilities depending due to the fluctuations in a currency. Translational risks are typically longer term in nature, such as factories in a foreign countries, long-term debt, etc. So mainly, if we are talking about the translational risk, that is typically in a longer term in nature, because all those factories who have established in a foreign currency, that is all about basically transnational risk is all about to multinational corporations. All those multinational corporations that are dealing in some other countries, this is for only those companies, and long-term debt, etc. Transnational risk directly affect the accounting earning of a company, although it doesn't directly affect the cash flow. Okay, the impact of earning is driven by change in the foreign currency. The translational risk directly affect the accounting earning of a company, although it doesn't directly affect the cash flow. Clear? If we will try to explain this particular risk through the example. US manufacturing company has purchased a factory in Canada. A US manufacturing company has purchased a factory in Canada to produce one of their product line. On day one of year one, this factory is worth rupees $1 million, 1 million Canadian dollar, and the USD CAD spot rate that is called 1.3. The company earning are at risk if the value of the CAD goes down. If the Canadian dollar is got depreciated, then there will be a huge risk, as the asset will be translated back to the US dollar for reporting purpose on the annual basis. So there are two things company has to be understand. They can do nothing and simplify translate their Canadian dollar denominated asset at the end of the each quarter. This completely expose the company to swing in the Canadian dollar, will be there positively by negative, and will have a directly impact on their net earning, even it doesn't impact. If there is any fluctuations in a Canadian dollar, there will be impact on their earnings also. Okay, so what they have to do, they have to be understand how much Canadian dollar is appreciating or depreciating in a certain period of time. Now, secondly, we'll talk about the client can hedge this currency risk by employing a rolling hedging strategy using the forward. If they are reporting on an annual basis, the company can manage the risk by selling 1 million Canadian dollar for 1 year starting on the first day of the reporting period. So if suppose that this is what they can do, they can hedge their risk. They can use, they can rolling their hedging strategy. What they can do, they can sell the 1 million Canadian dollar for the 1 year starting on the first day of the reporting period. So at the end of the reporting period, the Canadian denominated asset will be translated back to the US dollar at the prevailing spot rate on that day. This creates a translation gain or losses on the company's asset or liabilities. So we have translation method, current and non-current method, monetary and non-monetary methods. Temporal methods, current rate methods. Okay, so we'll try to explain you each method one by one. First is the current and non-current method. The underlying principle is that asset and liability should be translated based on their maturities. The underlying principle is that asset and liability should be translated based on their maturity. Current asset translated as a spot price. What is all about the spot price? Spot price is all about buying and selling the security. Buying and selling the security. Selling the security against the payment. Okay, so current asset translated at the spot rate and non-current asset translated at the historical rate. Historical rate is all about the past rate. So non-current asset translated at the historical rate in effect when the items was first recorded in the book. Whenever the very first items were recorded in the book, we will take the prices of that particular date. Okay, so current asset translated at the spot rate and the non-current asset translated at the historical rate. What are the historical rate? Historical rate we will consider on those rate when the very first items was recorded on the books. That is all about the current and non-current method. Further, this method of foreign currency translated was generally accepted in the US from 1932 until 1975, at which time FASB had become effective. Okay, so this method of foreign currency translation was generally accepted in the US state from 1930 until 1975, at which time FSAB it became effective. So current non-current method, current asset translated as a spot rate, that is called €2 is equal to $1. Non-current asset translated as a historical rate in effect when the items was first recorded in the books. €3 is equal to $1. So balance sheet, cash, inventory, net fixed asset, total asset. So 2100, 1500 and 3000. So that will be total, that is all about 6600. Non-current asset we are taking on the basis of the historical prices. Current liabilities, long-term debt, common stock, retained earning. Okay, so you can take it the screenshot of this particular slide. Okay, so local currency, that is called spot price. On the spot price, 2100, 1500, 3000, that will become 6600. Again 1200, 1800, 3000. 2700, 5700, and 900, 6600. Total asset and total liabilities were equal. If you will talk about the current and non-current asset, 1050, 750, 2800, 66, 12, 921, and 72800. Okay. Further moving towards second model method, that is called monetary and non-monetary method. The underlying principle is that monetary accounts have a similarity because the value represents a sum of money whose value changes as the exchange rate changes. The underlying principle is that monetary accounts have a similarity because the value represents a sum of money whose value changes as the exchange rate changes. So all monetary balance sheet account, cash marketable securities, account receivable, etc. of a foreign subsidiary are translated as a currency exchange rate. Okay. So the underlying principles is that monetary accounts have a similarity because the value represents a sum of money whose value changes the exchange rate change. It's quite easy to understand. And all the monetary balance sheet account such as cash, marketable securities, account receivable, etc. of a foreign subsidiaries are translated as a current exchange rate. Okay. And all other non-monetary balance sheet account owners equity line are translated as a historical. So all monetary balance sheet account will be translated as a current exchange rate, but all other non-monetary balance sheet account are translated at a historical exchange rate, in effect when the account was first recorded. All monetary balance sheet are translated at the current exchange rate. 2 is equal to 2 euro is equal to $1. All other balance sheet accounted or translated as the historical rate in the effect when the account was first recorded. 3 into 1. So again, you can understand here non-monetary method: cash, inventory, net fixed asset, total asset, current liabilities, long-term debt, common stock, retained earning, total liability and asset. So it's again equal. But here there are some certain differences between the in a monetary and non-monetary. Here is a 2550, here 2400. Due to certain why differences are coming due to certain differences in a foreign exchange. Next is the temporal method. The underlying principle is that asset and liabilities should be translated based on how they are carried on the firm's book. The underlying principle is that assets and liabilities should be translated based on how they are carried on the firm's book. Okay. And the balance sheet accounts are translated at the current spot exchange rate if they are carried on the book of their currency value, current value. So what is temporal method? Temporal method is all about temporal principle is that asset and liabilities, all the assets and liabilities should be translated based on how they are carried on the firm book, how they are carrying their asset and liabilities on the firm book. Okay. And balance sheet account are translated at a current spot exchange rate if they are carried on the book at their current value. So it's quite easy to understand. The underlying principle is that asset and liabilities should be translated based on the how they are carried on the firm book. It will be same. But balance sheet account, how the balance sheet account will be translated? So balance sheet account, what will happen with the balance sheet account? So balance sheet accounts are translated at the current spot exchange rate. Please note down this point. Balance sheet accounts are translated at a current exchange rate if they are carried on the books at their currency market or their currency value. Items that are carried on the books at a historical cost are translated at the historical exchange rate, in effect at the time the firm places the item of the book. So all those items that are carried on the books at a items that are carried on the books as the historical cost are translated at the historical exchange rate, in effect at the time the firm placed the items on the books. Further, again, item carried on the books at their current value are translated as a spot exchange rate. Items that are carried on the books as the historical cost are translated as the historical exchange rate. Okay. So local currency cash is 2000, inventory is 1500, net fixed asset 3000. So that will become total 6600. Current liabilities, long-term debt, common stock, and retained earning. That is all about 6600. Temporal is all about 1050 is cash, inventory is 900, net fixed asset is 1000. That will become the 2950. There is a slightly difference in what we call current liabilities. 600, long-term debt is 900, common stock 900, that will become 2400. Next is the current rate method. All balance sheet items except for stockholder equity are translated at the current exchange rate. All the balance sheet items, please do remember, all the balance sheet items are translated at the current exchange rate. And very simple method in application. It's a very simple, quite easy to understand. Quite easy to understand. A plug, equity account name cumulative translated. A cumulative translation adjustment is used to make the balance sheet balance. So what actually we do, we use the plug. We use the plug account name cumulative translation adjustment used to make the balance sheet balance. Whenever we just want to make the balance sheet balance, what we have to do, we have to use the plug equity account name, that is called cumulative translation adjustment. So we can adjust our balance sheet and we can make the balance sheet balance. All balance sheet items except for stockholder equity are translated at the current exchange rate. And plug equity account name cumulative translation adjustment is used to make the balance sheet balance. Here you can see balance sheet is balance. Cash 2100, inventory 1500, next fixed asset 3000, total asset 6600. Current rate 1050, 750, 1500, that is cost 3300. Liabilities also 1200, 1800, 3000, 2700, 5709, 6600. Again, liabilities in a local currency and currency rate, both in a both term, it's the same. So please take it down the screenshot of this particular slide. So all balance sheet item except for stockholder equity are translated to the current exchange rate of plug or equity. Okay. How various translation method deal with the change from 3 to 2 and equal to the 1. So balance sheet, local currency, current and non-current method, non-monetary methods, temporal and current rate. Cash 2100, 1050, 1050, 1050, 1050. Inventory 1500, 750, 500, 900, 750. Net fixed asset 3000, 1000, 1000, 1000, and 150, 1500. So it's a 6600, 2800, 22, 2550, 2950, 3300. So current liabilities is again it's not same. So how various translation method deal with the change from 3 to 2 equal to the per dollar. The spot exchange rate. These four are in the spot exchange rate. That is called prices are same. 1050 cash, 1050 cash, because whatever the currencies you have, if suppose it's the same currencies you are converting in a dollar or in some other currencies, the spot exchange rate is same. So the value of the particular currency will be same. Yeah, exchange value will be same. book value of the inventory at a spot exchange rate. Okay, but inventory is in a different there is a certain variations in inventory. The current and non-current method, there are $750, then a $500 in a monetary, then a temporal in a 900, and current rate in a $750. The book value of the inventory at a spot exchange rate and current value of the inventory at a spot exchange rate, that is called 900. You can see book value of the inventory at a spot exchange rate is the same, 750 and 750. But while talking about the current value of the inventory at a spot exchange rate, that is called 900, and book value of the inventory at a historical rate, that is called $500. Because in a historical, the price might be decreased, or price it could be the less prices. That is the only reason it's only just $500. We will talk about the historical rate. It's historically $1,000, $1,000, $1,000. In a spot exchange rate, that is called $1,500. In a spot exchange rate, it might have increased the currency exchange rate. So that is the only reason it became the $1,500. Spot rate 2,800, total asset 2,550, 2,950, 3,300. And long-term debt we will talk about. Historical rate 600. And spot rate is same, $900, $900, $900. And a historical rate, further we are moving towards $700, $150, $150, $550, and $360. From income statement, we can see retained earning is all about $700, $150, $550, and $360. So under this current rate method, plug equity account name, cumulative translation adjustment makes the balance sheet balance. Now, our various translation method deal with the further sales is about now, and the sales translate at an average exchange rate over the period 2.50 euro is equal to $1. Here is the same. Sales is 10,000. Translate at a 2.50 is equal to 1. Then it's a converting at 3,000, 2,500. Sorry, 3,000, 3,000 is the same. But if we are converting a 2 is equal to 1, then it will become the 2,500. Okay. If it's equal to 3, translate it to 3 is equal to 1. 3,333. If we are converting into 2.5 is equal to 1, then it will become the 4,400. You can take it out the screenshot of this particular slide also. Now, FSAB statement 8. What is this meaning? Essentially, the temporal method with some subtitles such as translating inventory at a historical rate, which is a hassle, requires the taking foreign exchange gain and losses through the income statement. Require the taking the foreign exchange gains and losses through the income statement. This lead to variability in a reported earning, which lead to irritated corporate executive. So FSAB statement 8 is all about essentially the temporal method with some subtleties such as translating inventory at a historical rate, which is a hassle. Requires taking the foreign exchange gain and losses through the income statement. Remember all these things. This lead to variability in the reported earning, which lead to irritated corporate executives. We'll talk about the FSAB statement 52. The mechanics of the FSAB statement 52 is all about the transaction process, function currency, and reporting currency. What is all about the function currency and reporting currency? Highly inflationary economies where the inflation rate is very high, just like a Zimbabwe, Venezuela, or some part of the South Africa. The mechanics of the FSAB statement 52. Function currency is all about the currency that is business is conducted in. In which currency which we are conducting the business, that is called function currency. Suppose that in India we are functioning currency, that is called Indian rupees, INR. Reporting currency is all about the currency in which the MNC prepares its consolidated financial statement. In the currency which the MNC prepares its consolidated financial statement, that is called reporting currency. Next is two-stage process. First, determine is which currency the foreign entitles keeps its book. What is all over the two-stage process? Firstly, determine is which currency the foreign entity keeps its book. In which currency you are keeping your books, whether it's a euro or dollar or Canadian dollar or pound or in some other currency. So firstly, we have to be determine in which currency the foreign entity means foreign companies are keeping its book. Suppose that Indian companies are dealing in a Canada. So Indian company means that is called they are dealing in India in INR, but they are dealing in a Canada, they are dealing in a Canadian dollar. Okay, so suppose that we have to determine कि Indian companies are dealing in the whether it's in a Canadian dollar or some other currency. The local currency in which the foreign entity keeps its book is not the functional currency. Suppose that Canadian dollar is not functional currency, then remeasurement into the functional currency is required. Then what actually we have to do? We have to go for the remeasurement of the functional currency. Then second, when the foreign entities financial currencies, when the foreign entity functional currency is not the same as the parent currency, when the foreign entity functional currency is not same as the parent currency, foreign entity book are translated using the current rate method. Okay, if it's not same, the condition you just need to remember, when the foreign entity functional currency is not the same as the parent currency, then what actually we have to parent currency in terms of the Indian company, INR will be the parent currency. So if the functional currency and the parent currency is not same, then foreign entity books are translated using the current rate method. Clear? Parent currency, foreign entity in the books kept in whether it's a Canadian dollar or Indian. Non-parent currency, functional currency, local or currency, current rate translation. Third currency, temporal measurement. Please take it out the screenshot of the particular slide. Foreign entity, the books kept in whether it's a parent currency or functional currency or domestic currency. Okay, so non-parent currency, so we have to be see on what is all about the functional currency, whether it's the home country currency or a host country currency. Home country currency in as per the Indian MNC, so Indian INR will be the home currency, and if suppose they started their business in Dubai, then dirham will be the host currency. Now next, high inflationary economy. If economy is a very high inflationary, then what actually we have to do? Foreign entities are required to remeasure financial statement. Foreign entities are required to remeasure the financial statement using the temporal method, as if the functional currencies were the reporting currency. If the functional currency were the reporting currency. Now, management of translation exposure. Translation exposure versus transaction exposure. Hedging translation exposure, balance sheet hedge or derivative hedge. Translation exposure versus operating exposure. Now, translation exposure versus transaction exposure. So what is all about your translation exposure? I have been already told you, any unanticipated change in the exchange rate has on the firm consolidated financial statement. That is called translation exposure. If suppose that any mishappenings or any changes, any unanticipated change in the currency or in exchange rate has on the firm's consolidated, has an impact on the firm consolidated financial statement, and accounting is the issue. If suppose that we'll talk about the transaction score, I've been told in a lecture number 16. Transaction exposure, the impact that unanticipated change in exchange rate has on firm cash flow. Here in terms of the transaction exposure, I have been told in a lecture number 16 or chapter number 16 or lecture number 16. The fact that unanticipated change in the exchange rate has on the firm's cash flows. The finance issue and the subject to the chapter number or lecture number 16. It is generally not possible to eliminate both translation exposure and transaction exposure. Now, hedging translation exposure means if the managers of the firm wish to manage their accounting numbers as well as their business, if the managers of the firm wish to manage their accounting numbers as well as their business, they have two methods for dealing with the translation exposure: balance sheet hedge and derivative hedge. What is all about the balance sheet hedge? Again, we have to start from there only. Yes, if the managers of firm wish to manage their accounting numbers as well as their business, they have two methods for dealing with the translation exposure. That is all about the balance sheet hedge and derivative hedge. If the managers of the firm wish to manage their accounting numbers as well as their business, they have two methods for dealing with the translation exposure. What is all about two methods? Balance sheet hedge and derivative hedge. Firstly, I'll try to explain the balance sheet hedge. Eliminate the mismatch between net asset and net liability denominated in the same currency. What actually we have to do, we have to eliminate the mismatch, whether the mismatch of the $1 or the $2 or $1,000. What actually we have to do, we have to eliminate the mismatch between net asset and net liabilities denominated in the same currencies. It may create the transaction exposure, however. If we'll talk about derivative hedge, an example would be the use of forward contract with the maturity of the reporting period to attempt to manage the accounting numbers. So what actually we have to do in a derivative hedge, in a balance sheet hedge, we have to eliminate the mismatch between the net asset and net liabilities. But in a derivative hedge, what actually we have to do, an example would be the use of forward contract with the maturity of the reporting period to attempt to manage the accounting number. We have to use the forward contract. And using a derivative hedge to control the translation exposure really involved speculation about foreign exchange rate changes. Now translation exposure versus operating exposure. The effect that unanticipated change in exchange rate, has on the firm ongoing operation. Whatever the unanticipated change in the exchange rate has on the firm ongoing operation, that is called translation. Operating exposure is a substantive issues with which the management of the firm should concern itself with. So operating exposure is a substantive issues with which the management of the firm should concern itself with. Now, empirical analysis of change from FASAB 8 to FASAB 52. They did not appear to revaluation of the firm values following the changes. This suggests that market participants don't react to cosmetic earning change. And other researchers have found similar result when investigating the other accounting changes. Other researchers have found similar result when the investing other accounting changes. And this highlight the futility of attempting to manage translation gains and losses. Thank you so much.